Hello and welcome. This is Professor Svark, and in this video I'm going to walk through topics from Chapter 12, which focuses on the very last financial statement, the statement of cash flows. So let's go ahead and review the financial statements that you are already familiar with. So go ahead if you can and lay out a basic income statement, statement of retained earnings, and balance sheet. And you don't have to do fancy ones, just a simple income statement will do. So if you recall, the income statement is revenues minus expenses equals net income. Even if you have a multiple step, it's sales minus cost of goods sold equals gross profit, that subtotal, minus your operating expenses equals net income. That's your income statement. Your retained earnings statement, and again, really simple form, is beginning retained earnings plus your net income, which comes from that previous statement, minus your dividends equals ending retained earnings. And finally, you have your balance sheet. And your balance sheet looks like the accounting equation. You have your assets, your liabilities, and stockholders' equity, which consists of common stock and ending retained earnings. And again, retained earnings comes from that previous statement. Now the statement that we're going to add today is going to be the statement of cash flows. Okay. What I like about this statement is it ties together all the financial statements. So kind of like when we balance our balance sheet, assets have to equal liabilities plus stockholders' equity, and there's a nice check figure here. Well, when we're doing the statement of cash flows, we actually tie together cash from the assets on the balance sheet and net income. So it ties together both of those financial statements. Now the reason that you would look at a statement of cash flows is because sometimes I shouldn't even say sometimes, most often net income doesn't reflect cash in. So your net income could be one number while your cash actually increased or maybe even decreased. So the statement of cash flows allows you to see what money was generated from your operations or any other activities, why net income and cash is different, okay, and look at the company's ability to generate cash flows and meet obligations. So I'm going to show you kind of the diagram. This is from your textbook, Statement of Cash Flows, and you can see it's separated into three categories here. We've got operating, investing, and financing. So we're looking at cash from operating activities, investing activities, and financing. Operating activities are everyday operations. So what cash should you get from just everyday operating your business? And this has to be related to your business. So cash from customers, less cash paid from expenses or costs. Okay, so cash in and cash out from your daily operations. Not a one-time gain, not a one-time, purchase of a building, but everyday operating activities. Here you can see it just shows net cash provided or used by these operating activities. Next is investing activities, and I like to personalize this. So if you had extra cash to invest in something, what would you invest in? Well, you might buy investments, or you might actually purchase a car. Oops. a house, okay, or the like, right? Well, companies do the same thing with their extra cash. They might buy investments in another company, right? They could buy the stocks of another company or bonds of another company, or they might invest in property, plant, and equipment. So any cash received for the sale or cash paid to purchase investments in either actual investments or property, plant, and equipment would be recorded in the investing section. Okay, and the financing section looks at how the company get financing. And just like you could personalize this, where would you go? Well, I might go to the bank, right, and get a note. But we know companies have additional ways to raise money. They could also sell stock or sell bonds. So any transactions related to notes, stocks, or bonds would go in the financing section. So the first part of this chapter really is to categorize. Do you know where different transactions would be recorded? The other thing I want to point out is that there's this non-cash investing and financing activities. So in this statement, we would note, for example, if you sold stock in exchange for a piece of land. There's no cash traded, but it impacts both of these sections. So we would actually call that out and make a specific note to say a non-cash item happened for the sale of stock. We received a piece of land. So the first challenge of this chapter is to know or to be able to identify where different pieces go. And remember, there's operating, that's everyday operations, investing, which is our long-term assets, property, plant, and equipment, or investments, and financing, which is stocks, bonds, and notes. And these are cash in or cash out. Okay, so purchase of a building, that's property, plant, and equipment. That's going to be an investing activity. And if you purchase the building, that's going to be cash out, a decrease in investing activities. Payment of dividends. What are dividends related to? They're related to our stocks. So this would be a financing activity. And again, if you're paying, it would be cash out. If you issue common stock, okay, that's a stock activity. It would also be financing, but this would be cash in. Payment of salaries, that's a regular operating activity, and it would be a cash out, but I'm not going to list it that way for operating. Redemption of bonds payable. What does that mean? Redemption means we're paying back the bonds payable. We're redeeming them or paying them off. And I know that's a tricky accounting word, but we're paying off the bonds payable. So that's going to be a financing, because we know bonds is financing, and it would be cash out or decrease. Cash received from the sale of goods is an operating activity. Proceeds from the sale of equipment. Equipment is property, plant, and equipment, so that would be an investing activity. So we sold a piece of equipment, that would be cash in. And finally, the exchange of land for common stock, there's no cash, so it's a non-cash activity. It would just require a note. All right. So there are two different ways to prepare the operating section. Okay, so remember there's operating, investing, and financing. The first thing that we're going to do is look at operating activities, and we're going to use the indirect method. So remember how I told you that I'm not going to use cash in or cash out for the operating activities. That's because I'm using the indirect method. The indirect method starts with net income And net income has some numbers in there that are not cash in and cash out numbers. So we're going to back into what is the cash number. So the way we do that is we add back depreciation or amortization or depletion. Those are non-cash expenses. For example, if we depreciate an asset, right, there's no cash payment. That's the entry dead. Depreciation expense, accumulated depreciation. No cash payment. So we want to add that back to net income. Okay, and again, you would do the same for amortization or depletion. Then you would look at gains and losses from a sale of our property, plant, and equipment. If you have a gain, you're going to take that out, and a loss, you're going to add that back. And the reason is that those are non-cash items too. So if you have a gain on a sale of a property, that's an additional gain because you're basically taking the difference between your book value and the cash received. Well, we're going to record the cash received in the investing section. So we don't want that gain to be reflected in net income. Okay, then we're going to look at current assets and current liabilities. So first we're going to look at current assets. And if you have an increase in a current asset, we're going to subtract it. And a decrease in a current asset, we're going to add it. And I know that seems kind of strange. Okay, so bear with me, but let me give you an example. If we were looking at accounts receivable, so money we were expecting to receive, and we started the year out with $1,000 of accounts receivable, but we ended the year with only $200. Well, how did that impact our cash? The receivables from customers went from $1,000 down to $200. That means we received cash. Okay, so if we have a decrease in a current asset, we're going to add that back in. The last adjustment we're going to look at is current liabilities. If we have an increase in a current liability, we're going to add it, and a decrease in a current liability, we're going to decrease it. Okay, the same thing goes with accounts payable, a liability. If you owe $500 at the beginning of the year, and you only owe $100 at the end of the year, how did that impact your cash? Well, you paid $400 of your balance. It decreased your cash. So if you have a decrease in a current liability, like accounts payable, you would take it out. All right, that feels like a lot to remember. But it's pretty easy once you practice. You're going to start with net income, add back depreciation, look at gains and losses, and do the opposite. A gain is normally a good thing, right? A gain is normally a positive, but we're going to take it out. A loss is normally a negative. We're going to do the opposite. We're going to add it back in. You're going to look at your current assets. If it's an increase, take it out. Decrease, add it back in. Okay, so far, it's really been the opposite. Depreciation is normally taken out, right? It's a negative. We add it back in. So if you can get those categories, net income plus depreciation, gains and losses, and changes in current assets, and realize that every single one of these adjustments is the opposite of what you are used to, and then just look at current liabilities, and that goes with the flow, right? We're going to add an increase, subtract a decrease. Okay, so once you get the four adjustments, or the four adjusting categories, and then just work through, are we adding or subtracting? And the only thing that I didn't add in here is for current assets, we don't look at cash though, because the overall statement looks at cash. And we'll see that at the very end here. So let's look at an example. A company's comparative balance sheet accounts is presented below. Net income for year 2 is $15,000. Depreciation expense is $3,000. Using this information, prepare the net cash provided by operating activities for year 2. All right, the first thing that I like you to do when you look at these is just add up your increases and decreases. right? The thing about financial statements is they read from left to right rather than right to left. So I like to just look at each line by line and look at how much did the account change, not including cash, that first one. So accounts receivable went from $90,000 down to $80,900. So it decreased $9,100. Inventory, so these are both current assets. Inventory went from $17,200 down to $16,500, a decrease of $500. And prepaid expenses, another current asset, went from $2,600 down to $2,400, a decrease of $200. So we have 3 decreases in current assets. Let's look at our liabilities. Accrued expenses payable, that is a current liability. It went from $1,500 down to $900, a decrease of $600. And accounts payable, it's a current liability, went from $9,500 down to $8,600. All right, so now we have all the information to plug into our formula. So I start with net income, add back depreciation, look at gains and losses, which I didn't see any, but I like to put placeholders. And then we're going to look at current assets and then current liabilities. So my net income was $15,000. I'm going to add back depreciation, which was $3,000. I didn't see any gains or losses. And then I'm going to look at my current assets and do the opposite. So I have 3 declines, so I'm going to add those 3 back. And this was an increase in accounts receivable, an increase in inventory, and an increase in prepaid expenses. Then I look at my 2 current liabilities, and those go with the flow. So here I have a decrease in, oops, what am I doing? Sorry. These are all decreases. Decrease, decrease, decrease. I also have a decrease in my accrued expenses, and I have a decrease in accounts payable. So liabilities go with the flow. So when I add up all these changes, I should get $26,300. It is a positive number, so this is cash provided by operating activities. If it was a negative number, it would be cash used by operating activities. All right, the next item that we're going to look at is investing. Oops. So again, investing is your property, plant, and equipment and any investments. So which of the following would be reported in investing? Purchase of equipment. Yes, that's property, plant, and equipment. Proceeds from a building. Yep, that's property, plant, and equipment. Redemption of bonds payable. That would not. That's a financing. Cash dividends from sale of goods. That would not. That's an operating. Payment of dividends. Nope. That relates to stocks, bonds, and notes. That's financing. An issue of common stock. Nope. That's also financing. So the only 2 would be the purchase of equipment and proceeds from the sale of building. Now, if these had dollar amounts associated, purchase of equipment, let's say for $10,000, and proceeds from a sale of building for $90,000. In the investing section, it's cash in and cash out. So proceeds from the sale of a building would be plus $90,000, and purchase of equipment, that would be cash out. So cash in and cash out. So your overall cash provided from investing activities would be $80,000. All right, and the same thing happens for financing. Oops, financing. Remember, that's stocks, bonds, and notes. So we want to go through here and say what amount of net cash provided or used by financing activities. The first thing that you want to do is figure out which items would be reported in financing. Stocks, bonds, and notes. So, what do we have here? The beginning cash balance, no. Dividends. Yes, dividends are included as stocks, bonds, and notes, right? They're part of a stock. Or not part of a stock, but they're part of stock activity. No, I'm sorry. My apologies. I misread that. This is dividends on stock investments. So that's investment we invested in. So that does not have to do with our stock. Dividends paid down below, that would be included. Interest paid would go up in operating, part of net income. Payment for goods, that's operating. Payment for operating expenses, operating. Bonds payable, yes, that would be included, right? Stocks, bonds, and notes. Proceeds from the sale of equipment, that is investing. Receipt from customers is operating, and taxes is operating. So the only two items that would be included would be proceeds, that's the cash received from bonds payable, less dividends paid. So we would increase this section for cash received, decrease it for cash paid. Our net cash received from financing activities would be $294. So that would be a large cash increase. And think about it. In financing activities, that's not an everyday activity. So if we had a large cash increase but net income was kind of mediocre, this would explain a lot to the user of the financial statements. Oh yeah, they had a big cash increase, but that's because they sold a bond. All right, the last thing that I want to do is go through a full statement of cash flows. Okay, so again, what I like to do is to go through this and look at increases and decreases. So cash, we're going to ignore at first because the entire statement will reconcile cash. But I want to look for current assets and current liabilities. So accounts receivable is my current asset. Again, from year 1 to year 2, reads backwards from a textbook. So $2,300 to $2,080. That is a decrease of $220. All right, land, buildings, and accumulated depreciation, those are property, plant, and equipment. I'm going to ignore those for now. And then I only have one current liability. Okay, so my accounts payable went from $3,150 down to $1,190. So that is a decrease of $1,960. All right, so let's go ahead and just start with, let's see, there's no information we need up there, right? Let's start with just the operating activities. So we start with net income, $2,290. I'm going to add back depreciation. Okay, I don't have any I do not have an income statement, so I don't know what my depreciation is, except that I can tell here my accumulated depreciation increased by $490. So I'm able to go ahead and figure that out by the increase in accumulated depreciation. Okay, then I would look at gains and losses. So let's see if there's any gains and losses. There's no non-cash activities. We had land sold for $480, and it says, hint, compute the gain or loss. So we know we have a gain or loss. So if I look at my land account, it went from $2,620 down to $1,960. So that is a decrease of $660. So I sold land it was on the books for $660 and I received cash for $480. So what does that look like to you? A gain or a loss? I receive less cash, so this is a loss, okay, of $180. So remember, for losses, we add them back. We do the opposite. So I'm going to add back the loss. Then I go to current assets. So I have, what was that? A decrease in accounts receivable, which gets added back. I'm doing the opposite. And then I have current liabilities, 1, a decrease in accounts payable, and liabilities go with the flow. That's the only one in this first section that goes with the flow. A decrease is a subtraction. All right, so if I have all my numbers right, I would end up with $1220. It's positive, so that's cash provided by operating activities. Okay. Then I would look at my investing. So this is my operating. I'm not doing a very pretty job here, but I'm not worried about you preparing a pretty report. I just want you to know where stuff is reported and how it's reported and how you compute everything. So, did we sell any property, plant, and equipment? Well, remember right here, the land was sold for cash. So, cash in or cash out is reported in investing and financing sections. So, we can say land sold here. If we sold land, does that increase or decrease our cash? Well, we receive cash, so it would be an increase of cash. Okay, so that's the only item that we're seeing. The building is the same, no change there. We already included depreciation, so we're good. So cash provided by investing is $480. All right, we have one more section, and that's financing. Okay, so this is stocks, bonds, and notes. So let's look at our balance sheet. Do we have any stocks, bonds, or notes? All I see is stock. I don't see any payables, any long-term payables. So if I look at my stock, it does look like we went from $68.20 up to $75.90. So stock increased by $770. That means we sold stock, so we must have received cash. Okay? So sale of stock, that's going to be $770. Okay, is there anything else? All right, I caught here that dividends were declared and paid $2,060. So if we paid them, it's cash out. So this is going to be negative $1290. So this portion is going to be cash used by financing. So if you have a negative number, it's cash used. All right, and I know this is getting a little messy, but let me just do my subtotals. Operations was $1220, investing is $480, and financing is a negative $1290. So I can add those three amounts up, $1220 plus $480 minus $1290, and I get a change in cash of $410. It's a positive number, so we have an increase in cash. Okay, now what we're going to do, let's see if I can shrink this up a little bit. What we're going to do is we're going to go ahead and take the beginning cash, $1,030, and see if that equals our ending cash. Oops, $1,030. Okay. And it does. I just did the quick math here, and it equals 1440. That equals our ending cash. So see how we added beginning and to confirm that ending cash equaled. So that is when you know that you've done the statement correctly. Now, if we had missed, for example, if we missed this dividends paid, you would know you missed something, right? They snuck that in there. I think this is pretty sneaky. We would know because our ending cash would not balance. And if you knew it didn't balance and you were able to see, oh, I'm off by $2,060, you could scan through the information and probably find it pretty quickly. But that is a statement of cash flows. Now, let me just talk in general. As a user of a set of financial statements, I would look at the statement of cash flows. It shows you for the time period. So this would be for a year. I would say, okay, my net income is $2,290. I would expect that cash is going to be greater than that, right? Because we know that depreciation, if you ever look at a real set of financial statements like Walmart or Best Buy or any of the companies out there, depreciation is usually a big chunk of non-cash. So whatever net income they have, add back depreciation, and then typically you're going to actually see more cash come in. Okay, but in this case, we had such a large increase in accounts payable that it didn't work. Okay, in addition to that, we would be able to see that they sold some land, and they also paid a large dividend. Well, a dividend payment is actually a good thing. So if I looked at this company, I would think, yeah, it's pretty healthy. It's paying off debt, right? It's paying off that accounts payable. It's paying a dividend. Okay, it sold some land. I might want to look and see what's going on. The notes of the financial statements will give you a better story. So you're able to see, well, why did they sell the land? Are they taking a new strategy? What are they doing? Okay, they sold some stock. Why did they sell some stock? Okay, and you might be able to find some of that information in the narrative of the financial statements. But in general, I wouldn't see anything that's unhealthy here. A lot of times what you see is you might see a large decrease in cash because they bought something. That's not bad either, right? But we know what they bought because it's listed as either investing or financing. Okay, the last piece of this chapter, and I will bounce back and say, for the exam, typically you're going to need to be able to prepare or to reconcile each of these three sections, right? So you're going to need to be able to prepare cash provided or used by operations, cash provided or used by investing activities, or cash used or provided by financing. All right, last topic here is going to be statement of cash. I'm sorry, not statement of cash flows. That's what we just did. Free cash flow. So free cash flow is kind of like a ratio where it shows the health of the company. So we would look at net cash provided by operating activities, but we know that in order for a company to be healthy, we want them to be replenishing their capital, meaning property, plant, and equipment. So we want them to be regularly investing in their property, plant, and equipment and paying dividends. So this is a healthy way to look at how much cash are they generating by operating activities, but let's take out capital expenditures and cash dividends because those are kind of things that keep a company healthy. So in this case, we could go and do free cash flow for the above scenario, and all we would do is we would grab the cash provided by operating activities, 1220, minus your capital expenditures, which there were none. We didn't buy any capital. We sold some, but we didn't buy any, minus our dividends. And we actually end up with a negative free cash flow, okay, which is not very good, except for the fact, again, I would look at this and say, well, we paid off some accounts payable. So I'm not quite sure what happened there. It could be just an anomaly that at the prior year end we had a large accounts payable balance, but we did pay off a large portion of accounts payable. Otherwise, though, again, it's operating minus capital expenditures, like property, plant, and equipment, minus your dividends. Okay, and we didn't have any capital expenditures. All right, so that is it for Chapter 12. You have completed all 12 chapters that we're going to cover in Accounting 101. So it's time to dive into studying for the cumulative final exam. So the final exam will focus on chapters 11 and 12, but you will find some cumulative questions